So, David Coulling, hello, hello.
Hello, hello.
Thank you so much for joining us here at Admirals. We are excited actually to have this interview with you and really listen what you have to say. Trust me, I prepared a lot of questions for you today. Okay. How are you doing, David?
Yeah, I'm doing good. Thank you, Theo. And thank you very much for having me on the show. Much appreciated.
Thank you so much, ladies and gentlemen. On behalf of Admirals and myself, and we would like to welcome you to this webinar today. With us, we have one of the famous traders, David Coulling, the expert in quantum trading. I could say it in the shorter version. So I personally look forward to this interview. I'm sure everyone will gain a significant amount of value from this gentleman. And yeah, I'm very excited to get started. But before we start, allow me to put the risk warning just as usual, and to let you basically know that this content is for general information only. There is no intention to provide any trading or investment advice or any kind of personal recommendation. Purely if we want to discuss about trades and if we want to talk about entry, stop losses, take profits, it's based on the way we see the market, based on our own beliefs, and it doesn't necessarily mean that this is going to replicate the exact same way in the future. All right. So, David, here we are.
There you are.
Not a lot of people on this webinar. And guys, please use the chat box below. I will just put a hello there. Let me know where you are, from which countries you are watching us. I'm very curious pretty much to know. All right, then please make sure you can communicate with me. Ask whatever you need to ask, and we will, David, of course, will answer it.
So I'll do my best.
So, David, let's start. First, kindly introduce yourself to our audience.
Sure.
How long have you been trading? Where are you currently from?
Okay, let me. I'll probably preempt that by saying that some of your attendees may be more familiar with Anna.
Yes,
they might recognize the surname.
Yes,
yes. She is much more well known than I am, but we're obviously husband and wife. But Anna's well known for her book on volume price analysis, along with the other 7 or 8 she's written. So if you recognize the surname, that's the reason why, because we're husband and wife. And it's quite interesting that a lot of people ask us how we manage as a husband and wife trading team, because trading is a solitary business, and I think it helps actually if your partner does understand what you're doing, because we talk to a lot of students and they find it very isolating and very difficult, because they may have a good day or a bad day, but if your partner or spouse doesn't really appreciate what you're doing, it's very hard for them to understand. So for us, we've been fortunate. There are other husband and wife couples out there, but not that many, I think. Anyway.
Yes.
We've been trading for longer than I care to remember. We started, and I know some of your attendees will find this hard to believe, but before the internet. So we were trading using, and I kid you not, we had desktop PCs that were the size of a small fridge, with a monitor to match, and there was no internet, so we had the data was delivered via broadband that was on a dish on the side of the house.
Yeah.
And we placed our orders by phone.
Wow.
That was it. There was you couldn't click, there was no internet, there were no screens. The live data came in, it was delivered, and if you wanted to place an order, we placed it via the phone.
Wow.
We'd been involved in the City of London. We lived just outside the City of London at the time. In a previous life, we were involved in contract lighting, and part of that business involved us going into a lot of the major banks and institutions in the City of London. And we used to spend nights wandering about on the trading floors, the dealing rooms, and all the rest of it, and seeing these traders, and we wondered what they did. So we were kind of on the periphery of it. At the time, there was a thing called Big Bang in London, which was really the deregulation of the financial markets, which we were on the periphery of. And that's really what kind of got us interested. And the national press also started to pick this up, because at the time, trading and investing for the retail trader was almost non-existent. It didn't really exist as an opportunity. So all of that happened, and simultaneously the media started to pick it up. So you started to get regular articles, and it was from an article that, ironically, Anna saw in the Sunday Times, one of our UK publications, and it was a trader. He was running a program in the city, and he was looking for, obviously, people to join and pay.
Yeah.
Which we did, and I went along to it first, and it was a 2-week program, and we were very fortunate. We didn't know it at the time, but he taught the basics of volume price analysis. He taught volume, and I think over the years, I think what we find is that volume either strikes you immediately and you take it on board, and to you it makes sense.
Yeah.
It's just an intuitive element of the trading puzzle, if you will, and it just grabs you and you go, yep, I get that. It makes sense to me. And that's how it struck both Anna and myself. We sat there and we thought, do you know what? This just makes sense. If you want to see, and you can actually relate it when you think about it, you think to anything in human endeavor. If you want to succeed, you have to put effort in.
Yes.
And if you want to see the market rising, you have to see effort going in. And it's that very simple concept, I suppose, of effort and result. If a candle is rising and it's rising on good volume, then everything is an agreement. Because the volume price methodology is really premised on this very simple concept of, is price and volume in agreement or is it in disagreement? So that is in essence what it boils down to, and what you're looking at the whole time. Does this candle align with this volume bar, or is there some anomaly? Have we got a narrow spread candle with a higher level of volume? Have we got a widespread candle with relatively little volume? And it's all of that. And that, in essence, is what it's about. It's very simple in concept. But as I say, of all the people we've spoken to over the years, of all the emails we get, people either take it on board and go, yep, I get this, and it just makes sense. And I think for a lot of traders and investors out there who've maybe been struggling, they've got 80% of the jigsaw puzzle in place, or they've got most of their trading approach in place. They may be, they use Fibonacci or some other approach, and they just can't find that missing piece. And it's volume is generally the missing piece. And the beauty of it is you can apply it to any market, any time frame, any instrument. It doesn't matter, and it can be built on in layers. So you don't have to take a particular approach. You don't have to take, indicators that overlay them. It is the foundation of whatever you wish it to be. It really is as simple as that. And all you need is a price chart with volume on, and that's it.
I'm sure the audience so far, they get excited and want to know more about this, and that's what we're going to dive into it with detail. At this point, I would like to, although you already answered many questions I was about to
And we've been doing this. We've been doing this for about 30 years now. So you can tell from how old I am. We've been doing this a few years now.
Nah, you look pretty good. So, I would like to ask you,
sure,
what was the biggest challenge? Because let's simplify it. I mean, we have traders that they start their trading career, let's say a month ago. Other traders a year ago. Other traders a few years ago, and they pretty much all come to a realization of, I'm doing something wrong.
Sure.
What is that? What I'm doing? What's that missing from my trade? What do I need to learn in order to be a successful trader?
Sure.
At sometimes what it takes, maybe it's a little bit of belief to build within themselves, within their strategy, and as you prescribe, and we're going to go into more detail, the volume analysis that it's going to, if you add it into your tool of arsenal, maybe you're going to have the desirable results. So I would like to ask you, what was, let's say, the biggest challenge you have to overcome at the stage of your trading or investment career?
True.
That you say, okay, thanks God I went through, or okay, that came for the reason, I'm keep moving onward. And what was that thing you remember, if you recall about something?
I think the as I said, we were very fortunate in that we came to volume first.
Yes.
And that to us, I mean, at the time, we didn't know that.
Yes.
And again, talking to all the students and the people we've met over the years and the people who email, unfortunately, this business, investing or trading, it seems to be that you have to go through this very tortuous process of really finding out what works for you. And we were very lucky. Volume came to us as a first point of call. It doesn't happen for many people like that. And what a lot of people go through is they try this, and it, as you said, this doesn't quite work. Oh, what am I doing wrong? Okay, let me try something else. That doesn't quite work. A lot of new traders, let's be honest, they tend to start with a very simple indicator. And the reason they start with a simple indicator is because I've said it, it's easy. It's a very easy way to start. It's an easy way to get into the market. It doesn't involve a great deal of thinking. And I think if you encapsulate volume and what it actually requires, and let's face it, it's not everyone's cup of tea. Remember, this is a discretionary approach to trading.
Yes.
Now, you can either be a discretionary trader or you can be a systematic trader.
Yeah.
And sometimes, the two don't match, and it doesn't suit your style, which is why we always say within our programs with our students, the first point of interest is to really understand yourself, your psychology, your makeup. Because if you're trying to force yourself to do something that you're uncomfortable with, if you're trying to be a scalping trader and your persona is not suited to that, it's not going to work for you. So it's really important. I know a lot of people don't pay much attention to the psychology, and they often come to it last as well, funnily enough. They'll go through all this pain, and they'll go, oh, well, maybe I should understand myself better. So, it's another thing that we often say. We say, look, if you understand your personality traits, your strengths, your weaknesses, and then try and build your trading approach around that so that it actually fits. If you're trying to be a scalping trader, I trade 15-second charts, which some of your listeners will be horrified at. They would never have looked at a 15-second chart. To me, I'm quite comfortable with a 15-second. I'll have others up and have a 15-second, a 1 minute, a 3 minute, something like that. Yeah. That's fine. When I'm scalping, no problem at all. I'm quite comfortable with that. It doesn't bother me. I've been doing this 25, 30 years. I wouldn't expect someone new to be comfortable with that. And if you're trying to force yourself to do that and trade off a 1 minute chart and you're not comfortable, stop doing it. Go to a slower time frame. Maybe you're more suited to a 30 minute, an hourly, a 4 hourly. It has to match your personality, your traits and your persona. And as I say, a lot of traders will find discretionary trading difficult. They will be more suited to a systematic approach. Now that can be at one end, obviously you've got algos and EAs and all the rest of it, but you can also have a systematic approach which is rules-based. Now, Anna and I don't believe, unfortunately, that the volume approach can really be, it's too nuanced to actually make it into a rule-based systematic approach. But you can certainly make rules based around other aspects of price action. So all I would say to those listening is if you're struggling, first of all, just pause for a moment. Just try to understand yourself, because that way you will find what ultimately will work for you. And I would hope that volume would be part of that element if it is. And if you've maybe got a strategy that kind of works, but you're finding holes in it and it's just not proving consistent, then maybe volume is the missing piece to actually build in underneath. You don't have to change anything else. That's the beauty of volume price. You haven't got to change a thing. All you're doing is you are bringing in another methodology which is underpinning what you're already doing. Now, you said to me that's the hardest part.
The volume. I think volume analysis on the existing trading strategies each trader maybe.
I mean, for example, we see there's a lot of comments around the book. Elliott Wave, for example, a lot of traders now, they use Elliott Wave. Absolutely fine. But what they've found is that if they then bolt VPA underneath it, it just takes it to a different level for them.
Yep.
And that's the difference. Now, you asked me, Theo, you said, what was our sort of, what point did we kind of not cross the Rubicon, but, did it become, did it fly, if you like? And I think the thing with it is that you have to put a lot of effort into this. It does take a lot of study. It takes time to actually become comfortable with it and to do it at the speed that you need to do it at, particularly if you're trading intraday, where things just pop off the screen and it's just immediate. You see things immediately. So I would say, I mean, we spent the first 6 months, this sounds ridiculous, but we spent the first 6 months just testing one another. We printed off charts and we just went back to the beginning and we just sort of walked through a chart like that just to see and read the chart in that way, because we didn't have so much, there wasn't so much technology available. Now what we say to students who want to learn VPA is the best way for you to learn is to get yourself a chart. It doesn't matter what it is. It doesn't matter what market it is. A nice fast chart, maybe a 1 minute or a 5 minute, preferably a 1 minute, and just study the candles as they come in with the volume and start to build up your knowledge that way. And that's the way that we recommend and always advise our students to learn. And start very simply. Just look at single candle, single volume.
Yeah.
Is this candle in agreement with this volume or is it not? And the classic ones to look for initially are a little hammer candle where you've basically got the price has opened, fallen, and opened back at pretty much the close. So you get a very narrow body, a nice deep wick, and you look at the volume on it. Now that's an anomaly. It has to be, because if that were not anomalous, the price would have closed at the low of the day or the session, whatever the session is. And it hasn't. It's recovered. So within that candle, you can say, yes, the price fell and the price rose again and closed pretty much at the open. Now, a price trader would say, oh, yeah, well, I know that anyway. I don't need volume. Because we get that quite often. That's often, oh, I don't need volume. I just read a price chart. Well, that's fine. Of course, that price candle tells you that. But what it doesn't tell you the strength of that buying that's come into the market.
So based on this example you just mentioned, David, let's say we are, just to make it more schematic, let's say we are coming from a downtrend. So the price is falling. We find pretty much a layer of support, and then we see a printed bullish hammer, a hammer or a pin bar or a reversal, let's say, candlestick line. So walk us through, what do you want to see in the volume at that particular moment?
Prior to that, if we're talking about a downtrend, and now we're opening out the volume price methodology into the broader context of not just looking at one candle at one volume bar, we're looking at groups of candles and groups of bars. So just taking your example, let's say the market is falling. The one thing we'll be looking for there is the volume associated with that fall. Now, everyone is familiar with gravity, so we all know it takes effort for a market to rise. That's intuitive. We understand that. What is less intuitive is the fact that it takes effort for the market to fall. So in the same way, when you see a market that's rising, you want to see that market rising with nicely rising spreads on the candles and nicely rising volume. That's a perfect scenario, which doesn't often happen, but that's what you're looking for the whole time. In a downtrend, you're looking for the same thing. You're looking for widening spreads, but you're looking for rising volume again. So you've got the market falling, you've got volume rising. As you get to the bottom there, you get this, let's say we have this one hammer candle. Now, what that's signaling is that potentially, and I use the word potentially, the market is approaching a reversal point. The one thing that I think, to answer your earlier question about the hardest part of VPA, is when you see a very strong signal like that, you've seen a market fall and you've got a really strong hammer candle, you've got a ton of volume coming in, your instant reaction as a VPA trader is fantastic. Time to jump in. It's very, and that's the biggest mistake, I think, and the hardest thing to learn is that occasionally it's true to say that you do get what we call V-shaped rallies like this, where the market literally comes down on one candle and shoots off back up the other way. They do occur, but they are relatively rare. They occur for lots of different reasons, but they are rare. Generally speaking, what happens with a volume price analysis is the market's been falling, selling pressure's been rising. We then get our first signal that potentially buying is coming into the market with some strong volume under that candle. Now, does that mean the market is immediately going to wang up the other way? Generally speaking, not, because what there happens thereafter is that, and if you think about this logically, where you've had a lot of heavy selling, for the market makers to absorb all that heavy selling, it's generally too much to happen in one single candle. It takes several candles for that to occur. So we get a congestion phase. And the analogy that I always use when we're teaching is that, think of it like an oil tanker, which has huge momentum. Now, if the captain switches off the engines, that oil tanker will carry on for several miles under its own momentum before it comes to a stop. And it's very similar in this sense in terms of volume. The market makers have come in, they're going to accumulate, they're going to stop. This is what we call stopping volume. See that volume on that hammer candle. The market will then generally tend to go sideways. There will be more buying coming in. You will tend to see thereafter, following that large initial signal that's kind of got your alarm, you've woken up and you've gone, right, time to pay attention. The chances are what you then see thereafter is you then see further buying. So you might see more hammer candles, but with smaller volume under it. So in other words, what that's telling you is that the selling pressure is now being diminished. It's being drawn out of the market. Yes, we've got further hammers following, but look at the volume. The volume related to the first stopping volume candle is much lower. And gradually you get to a point where, and again, I use an analogy, it's called mopping up. It's like when you mop up a spill with a cloth, you generally don't get it at the first attempt. So it takes 3 or 4 efforts to go.
Yes.
And that tends to be what happens. So then you go into a congestion phase, and then you start to look for the breakout to the upside. So, in terms of reversal, I'm a huge reversal trader. That is my number one strategy, if you like, tactic to market, is I look for reversals because I'm greedy. I like to get in a trend early. I don't like jumping on a trend once it's underway because I've lost, the first third of the trend or whatever it is. So I'm always looking to get in early.
Yeah.
The quid pro quo of that is that if you're looking to trade reversals, you have to set a wider stop loss to accommodate for this buffering that goes on that I just talked about, where the market is in congestion. Now, if you want to wait, that's absolutely fine, because it kind of brings in the next level of volume price analysis, which is all about support and resistance. Now, we've got the hammer candle, we've had our congestion phase, we've built a nice channel of support and resistance.
Yeah.
Then the market starts to creep higher and eventually starts to break out. So what are we looking for now? I won't go into tests because that's another level of VPA, but what we're looking for now, we've got this really nice channel of price support in place. And we're now looking for a candle to break out of that to the upside if we're going to get a strong reversal in trend. What are we looking for in terms of volume on that candle? We want to see good volume. So we want to see a nice candle without wicks. So, small wicks is fine, but you don't want to see big wicks on that candle. You want to see a nice solid candle with maybe a tiny little wick top and bottom and a good volume, confirming that that candle is valid. Because this is the other problem. Breakout or breakaway trading is very, very popular. Yeah. And it's popular for lots of different reasons. I love it. Now, the reason a lot of traders struggle with breakout trading is because they get caught with what's called fake outs.
Yes.
Which is where the price breaks, it pops, and then it immediately goes back into the congestion, or it doesn't go very far before it retraces back into the congestion phase. And the reason the vast bulk of those breakout traders struggle is because they're not using volume. They don't know whether that breakout is genuine or not. And this also is another concept of the whole VPA methodology, which, again, you have to buy into the principle of it. That is the principle of it, in that, and by that I mean that the fact that you accept that market makers are able to manipulate the market. Now, if you find that hard to believe, all I can tell you is have a look at candles during the London Open, have a look at candles in the US crossover session, or when there's a piece of fundamental data, or just prior to a piece of fundamental data, or just after. You will see huge candles with very little volume, where the market is just being moved at their whim. And that's the underlying principle of VPA, in that the market makers are there to trap you onto the wrong side of the market. And what we are doing in following volume is really following their footprints in the sand. And that's it. If the volume is in agreement, we can assume that the market makers are playing. If the volume is not in agreement, in other words, to use that breakout analogy, if we had a nice candle coming out, but there was very little volume under it, clearly the market makers are not participating. They're not joining that move. It's just a little trap move. You see these traps all the time. They are endless. They are cruel. But it's the game we play. It's a hard game. Wow. It's a hard game.
I'm sure, David, so far, everybody here, they find it extremely, extremely interesting what you are talking about, what you're explaining about. And just to answer a few comments they came here, you cannot see anything on the screen because we don't share the screen, guys. It's only myself and David. Okay, we don't, there is no sharing screen of the charts. We don't show charts. Okay, just to make it clear. And What I would like to ask at this point, because you mentioned, and to make sure that our audience and those who want to watch it later, they're not going to get it wrong.
Sure.
By explaining the volume analysis, the volume methodology, we don't mean at any point that losing trades won't occur to a trader.
No.
It's not like we have the crystal ball like I described it on my live morning trading session. Like, hey, today I have that crystal ball and the tax bill.
I wish. I wish.
Yeah. So
sure.
Just to ensure that, yes, we still gonna get the losses, but what you are explaining, it's a highest probability to add something.
Yes.
Kind of an inside, let's say.
Yes.
Nature.
It is not perfect. Of course, it works. Sometimes it fails, and you have to accept that.
Yep.
But the one thing it gives you the confidence to actually take a position in the market, and really, it is such a powerful methodology. It does take time. I'm not going to kid anyone who's listening to this and say you will learn this in 5 minutes. You won't. There are many nuances to it. It takes time to learn. But I would say if you study and put in the effort, you will get the rewards. But it takes time. But then, as I would say, anything that's worth doing is worth doing well. So, it's putting the time in. But yeah, I would agree with you 100%. The other thing I wanted to say about volume price analysis is this. We've talked about a very simple example where the market's fallen, we've gone into conjunction and we've come out the other side. And support and resistance is an absolute key part of the whole methodology as well, but then everyone understands support and resistance. So again, it's just bolting it into something perhaps you already understand. But the other thing I wanted to say about volume price analysis, and this is perhaps its greatest strength.
Okay.
And this is where a lot of traders, and I'm sure we all struggle with this. What I'm about to say is the one thing that we all struggle with. You can have within trading and investing, the hardest thing we all find is to stay in a trade, to stay in a position once you have some money in it. And that's human nature. You open a position, you're a few dollars up, or you're $50 up, or you're $100 up, and what's your immediate reaction? What's your instinct? Your instinct is to close that position, take that money off the table, put it in my bank. That's it. I'm done. I've had enough. I can't take anymore. Oh, it's dropped down over to 100. Now it's 95. 90's for 92. I must take it.
Yes. I cannot.
Right.
Coming to break even. I don't want to see a loss.
We all go there. It is something we have to accept. We are conditioned that as human beings, that where we have something in profit, we want to keep it. We don't want to lose it. It's very dear to us, and particularly so in trading, because let's face it, we have more losses than we do winners. And this brings me to the point, which is this. The mathematics of trading, and really trading per se, is that if you take 10 trades, as long as your losses are small and you're using a stop loss, which I hope that everyone listening in does.
Oh, yeah.
You can have 7 small losses and you can have 3 bigger winners, and your trading account will move forward. It's not a case of looking at 10 trades and saying, well, I had 5 losses and 5 winners, and the trading account is moving forward. It's a question of the size of your winners versus the size of your losses. Now, the issue is actually staying in a position. And that's the biggest emotional problem that we all have to deal with. We have to deal with that and manage that emotion. And that is where volume price analysis really plays to its major strength. And I'll give you a word example. So we'll talk about another word example here, if I may.
Yes.
This is a very simple example, okay? We have a rising market.
Yep.
We have nicely widening candles, So we're going up, nice little soldiers, maybe widening a little bit, and our volume is rising nicely. So we're very happy. We're in profit and we're happy. And then what happens? The market pauses and we get maybe a little narrow spread candle. And we think, okay, well, maybe the market's going to carry on. And then the market starts to reverse. And we get a series of maybe 2 or 3 candles which reverse against us. And at that point, we panic, the emotion kicks in, and we close out.
Yep.
End of trade. What is actually happening is, if you look at the volume, and I'll give you a classic example, if those 3 or 4 candles are falling, and they are falling with falling volume, then that is telling you one thing and one thing only, that this reversal is not a reversal, it's just a minor pullback, and that in the fullness of time, you would expect the market to continue on the original trend.
Wow.
It's called a secondary trend. It's part of Wyckoff. The initial rise higher is your primary.
Yep.
This little move down here, where your retracement, your pullback, is called a secondary.
Yep.
Then you want to see it go up here. But you only know if that is a secondary if the volume is falling. Because if the volume is falling and the price action is falling, it is telling you one thing. It is telling you this market is not strong. In other words, the selling pressure is weak. This is just people taking profits. It's just people getting out of their positions, as indeed you are thinking of doing yourself. That's what's happening. It's not the market makers coming in and you've got, falling price and rising volume, in which case, get out. It's time to head for the hills and bank that profit. But if you're seeing those candles falling lower, you've got 3 or 4 maybe candles, maybe the spread is not very wide, but the volume is falling underneath it, the down volume is falling. It's telling you, don't panic, stay in. And it's as powerful as that. And of course, the other aspect which we haven't talked about is that everything you do is in multiple time frames. We're not looking at one chart here. We are looking at ideally 3. And the way we always explain this is really think of it as a 3-lane highway, if you like, a motorway. So you're driving in the middle lane and you've got your wing mirrors either side. So you've got fast traffic on one side, slow traffic on the other, and you're in the middle lane. And that's your trading window, if you like. It's your trading view of the market. So you're seeing what's going on both sides of your trading panel, if you like. Yeah. And that's the chart. The center chart is probably the one you take the trade off. You're then looking for what's going on over here on the faster time frame. And is that replicated through to your slower time frame? Because if you think about it, a trend will always start in your fastest time frame. So let's take a very simple example, a 1 minute, 3 minute, 5 minute, for example. Yep. 1 minute time frame, your trend will begin. If it's a true strong trend and maybe a change in trend, maybe reversal, you will see that ripple through into your center console window, your 3 minute, and ultimately it will go out the other side into your 5 minute time frame. So that trend will have gone right the way through. Now that trend may go out to the half hour, the hourly, and so on and so forth. The analogy we always use is of using dropping a pebble in the pond. You drop a pebble in the pond, and the ripples from that action of falling in the pond, they ripple out across the time frames. It's exactly the same here. And the other thing also, which is important, I know I'm piling quite a lot in here, but the other thing to appreciate is that slower time frames will always trump faster time frames. So what goes on if you've got, let's suppose, for example, using that 1-3-5 minute analogy, maybe you've got in on your 3 minute, you're looking at your 5 minute time frame. Now, if you see on your 5 minute time frame quite a strong area of resistance, and you've got some maybe resistance on your 1 minute, the resistance on your 5 minute time frame, which you're coming up to, is always going to trump. That is the strongest because it has time. The longer something has been in an operation in terms of time, then the stronger will be that area, whether you're talking about resistance, support, congestion phases, whatever it is. time is always the governor, so that if you look at it, if you've got a strong resistance area on a daily time frame, that is always going to trump what you have on a 4-hour time frame or an hourly time frame. So sorry, we've gone off at a bit of a tangent there.
No, that's okay. That's okay. It's pretty much. I would like to ask you, do you look at fundamentals when
Sure.
you're trading?
Yeah, absolutely. The fundamentals come in to play and it depends.
Oh, sorry. Or maybe first, it's better if I ask you which markets
Sure.
do you usually trade?
Yeah.
We go to
Sure.
what kind of fundamentals
Sure.
are you looking for?
Okay. The markets we focus on predominantly very much are Forex, and I personally do a lot of index trading, index futures,
Okay.
and options as well. And we have stocks really much more on the investing side, but we get involved in stocks via stock options. So we really cover the entire market, if you will.
Yeah.
But it's interesting because you look at, obviously, some markets you look at purely speculative, like Forex tends to be very speculative, whereas stocks is obviously much more towards the investing side, although there's speculation in there as well. So yeah, a lot of Forex and a lot of index options. So
Okay.
those are sort of two primaries.
Yeah. And because you said you are a fast time frame trader,
Yeah.
I assume that we all know. Let's take one of the news events that nobody can surpass it. That's the non-farm payroll.
Sure.
Yeah, every first Friday of each calendar month.
Yeah.
Then
Yeah.
during that time, we know that maybe the market is going to start moving sideways prior to that quite some time until the event will come and the outcome and so on.
Yeah.
Are you trading the event itself?
No.
No.
This is a personal view. To answer your question about fundamentals, yes. I mean, it very much depends on your time frames. If you're looking at holding trades for days or weeks, I gave the impression that's all I do is trade, scalping. But I run the whole gamut. And to be honest, and again, we always suggest this to our students if they can, is to split the accounts into, right, well, this account is my scalping trading account, and this account is for my longer term, for my daily. We hold positions for days and weeks, I can assure you, and sometimes months. We've been in the pound for a long time. We've been in there months. But at the other end of the spectrum, we're in for a couple of minutes, 5 minutes, 10 minutes, whatever. Yeah. So yes, we do. We are very much on the fundamentals, which is, well, one of the books very much talks about the relational aspects. And again, it's the thing with Forex is it's always promoted as very simple, very easy to get into, which is true. It is. It's very easy to get started.
Yeah.
But it's a much more complex market, and the reason for that is because Forex sits at the heart of everything. And if you think about it, the reason that Forex market sits at the center is because when assets are being converted from one to another, if the market is going from risk on to risk off, and money is flowing from risk assets into non-risk assets, those assets have to be converted into cash. So at some point, they are going through the Forex market, and the Forex market is unique in the sense that it is a real chameleon of risk sentiment, which doesn't apply to any other market, because you have risk on currencies and you have risk off currencies. Yeah. Every other aspect of the capital markets has its own risk. It only has one risk profile, but the Forex market has this blend. And that's what makes it so fascinating, but also a more complex, to trade. Sorry, I've forgotten what your question was, Theo. Now, I was about the fundamentals. No, I don't trade I don't trade news items, purely because when you look at them from a volume perspective, you realize how manipulated they are. And truly, I would honestly recommend perhaps your listeners who are either skeptical about volume or perhaps looking to learn more, is look at volume through a big news item like a GDP release or an NFP release or whatever it may be, a resale in the sales or whatever, it doesn't matter what it is. Just look at the volume and the whipsawing that goes on, the sheer volatility and the manipulation that goes on. And you'll also see, can I say, in about the 5 minutes prior to that, what you often see is the absolute cynicism of the market makers who will move the market prior to that release in the opposite direction to which it then takes thereafter. And you will see that time and time and time again.
Wow.
All the time. So I don't trade news items.
Yeah.
I tell you what I do look for is, and again, this is something that's often new to Forex traders, which they fail to appreciate, is that when you come to session crossovers, it is a classic time for market manipulation by the market makers. So if you're trading up into the European Open at 7 o'clock our time or London Open at 8 o'clock our time, again, if you look at what goes on in the volume prior to those, just after, into the London Open, you'll see manipulation on a grand scale. It is very, very profitable for the market makers at that point to move the market in one direction and then reverse it almost instantly to catch everyone on the hoof. Those traders who don't understand, those traders who don't use,
I have a question for you. I'm sure many of our participants they want to ask you this.
Yes.
So let's take the London Open. All right, that's to be more specific.
Sure.
7:55.
Yep.
GMT time.
Yeah.
We have a 5-minute candle to play out until the London Open, and then 8:05 the next 5-minute candle.
Yep.
So what you are saying is that maybe within a long green candle, let's say a long bullish candle,
yep,
we're going to have an amount of volume that not going to necessarily reflect that
precisely
move. And that's going to be a very misleading.
Precisely. Absolutely.
Really?
Absolutely. You can see it every single day almost. I'm not saying it happens in that particular way, but that's what you will tend to see. Now, what you might then see thereafter is, let's take that example. You've got a widespread candle and you've got relatively low volume on it. And you think this doesn't look right. It's anomalous. Okay. It's anomalous. What happens on the next candle? The next candle, let's say we see a narrow spread candle with a lot of volume going in. What's that?
Sorry, just to clarify that, because maybe some people are not familiar with that.
Sorry.
What do you mean exactly? Clarify when you say a narrow spread candle.
Okay. So let's say we see our first candle is quite tall.
You are talking about the body of the candle?
Yes, the body. No, the body of the candle.
The body of the candle.
Let's talk about the body. So let's talk bodies here. So the first candle appears. It's a nice widespread body, but the volume is very low. We look at the volume and it doesn't look right. We think this is anomalous. This is a
long body with a fairly small amount of volume move.
Yes. Okay. Yes, exactly. The next candle comes in and we have quite a narrow little body. Okay?
Yes.
But we have a lot of volume with it, or more volume than we would expect.
Okay.
What is that telling us? That is telling us that the market makers are selling heavily into a weak market. The market is not receptive to price, but the market makers are forcing their volume through to just get the market to move a little bit higher before they start to reverse. Now, the third candle comes in. What do we see? Maybe we see a little body candle, and then we get a little wick or maybe a bigger wick to the upper body. So the market makers have forced the market up. Markets come back down again, but good volume under that candle. And that really is a sort of 3-candle scenario that I could paint and say that is typical of a trap forcing volume into the market, forcing volume again with the wick to the upper body on the third candle. And now we're starting to look for a reverse point. And at that point, I will be looking for a short.
Yeah.
Because that's telling me it's a trap. They're setting this up for a trap. And you may even have seen it set up for a trap before the 8 o'clock period, because you often see this too. And as I said earlier, when we were talking about non-farm payroll, if you look at the price action prior to one of these releases or prior to an open, you will often see, and you'll see it quite frequently in the European, you'll see the European market going up on no volume. You think, what's that all about? And it's rising into the London Open, and then, bam, we're off.
Yeah,
we get a fall.
Wow.
It's in a way, it's depressing in a way, Theo, and in that they are able to do this at will.
Yeah.
But in a comforting way, seeing it with volume. It is very cynical, let's be honest, but they were in a cynical business.
Yes.
I don't want to depress anybody, and I don't want to put anybody off trading because, with volume, as we said earlier, this is not your crystal ball. This is not the eureka moment. This is not, this is not going to give you everything you desire. But boy, oh boy, it will get you an awful lot further than you probably are at the moment.
Yes. At least it's going to validate more it's going to help to validate more your signal.
Absolutely.
David, at this point, I would like to let our audience know about your website and what can they find you, because I would like to spend the next 9 minutes left purely on the questions. I have a lot of questions.
Oh, gosh.
They are questions that really... they get me. We have to answer them because it's important for a trader. They are here. They are looking for some answers. But before we go there, allow me just for a couple of minutes to let the people know about your website, right? So,
Theo, one small favor. Have you got Anna's site there as well with just annacoulling.com? You probably haven't got it set up. Apologies.
No, I have the
don't worry.
.com.
Don't worry.
All right. So I think everyone is... we shared Anna's website last time.
Oh, fine. No problem.
I think we sent it emails, if I'm not mistaken. So, guys, quantumtrading.com. I will put the link on the chat box below so you can have a look at David's indicators, quantum trading, indicators for MetaTrader and TradingView and other platforms. All right. And you can read, of course, about Anna and David here. And I'm sure there is somewhere contact us here at the top if you need anything to contact. Also, there are some special deals, news and indicators, as we said, volume price analysis for currencies, strength indicators and all this stuff. And also they have the Learn Forex Trading at Quantum. All right. I will send you the link as well for this one here. And yeah, feel free to go through and understand more about volume. And I'm sure at some stage we're gonna get something with David to talk to, maybe to make a few more live trading sessions. Why not? To go through a little bit more about volume analysis, because that's very interesting in trading. And let's go back to the questions. Now,
Theo, sorry, can I just a couple of very quick things?
Sure.
First of all, which may be one of the questions you're being asked, is people will say, well, there is no volume in Forex. That's absolutely true.
Yeah.
There is no central exchange. What we use in volume is tick volume, and tick volume is activity. So to us, if you think of it, if you've ever seen a trading pit, one of the old-fashioned trading pits where traders would stand with and they would trade, they've got stripy jackets on and they trade in a pit. If that trading pit is noisy, then that's activity. And to us, that's volume. It's exactly the same principle. So that may be a question you're asked. Someone will say, well, we don't have volume in Forex. That's what we use. We use tick volume, and I can assure you it works 100%. The other point I wanted to make very quickly was about the indicators. The indicators are there to support the volume price methodology. They've been developed not to replace it, but they are there purely as
a great point.
The foundation methodology is volume price analysis, and we use indicators, for example, like a support and resistance indicator, to cut out the work of having to draw manual lines, we use the VPOC, the volume point of control, to give us volume up the side. So I just want to make that point, Theo. Just
thank you so much for clarifying that. So we have about 5 to 6
Sorry.
minutes. So let's go I will try to answer to ask as many questions as possible, and let's try to answer them in 5-6 minutes. So a question, you talked about 3 charts, 3 time frames.
Sure.
Can you please repeat what time frames you use? Or can you give a generic approach, let's say?
I would say, generically, I would say if I'm scalping, I would use something like that. I would use a 1 and 3 and 5. If I was more of a swing trader, I might use something like a 15 minutes, 30 minute, and an hour. And if I was a longer term trader, then I might be looking at the hourly, the 4 hourly, and the daily. It's really what makes sense to you, and to use and to keep them. They have to be relatively close. I mean, there would be no point in using a 1 minute with a 1 hour and a daily. That would not make sense. Yeah. So they have to be relatively close to your
3 time frames. The one higher and the one lower.
Exactly.
Okay.
The one in the middle is the one that I would look at as my trading window, if you like, and the one that I would take the trades off.
Oh, your execution time frame.
Exactly.
Okay. I have a question now. I know I've been asked that question, and I'm still asking that question from many, many traders. And at some point, it comes down to the individual if it wants to answer. I'm sure you already understand the question, David, before I asked it. And how much was your biggest profit? And again, if you want, you answer this question.
Biggest profit, it would be in 5 figures.
Okay, 5 figures.
I can't say any more than that.
No problem. So I'm sure the trader was that question. It's really.
Let me just qualify that and say that we've been doing this for 30 years.
Yeah.
And what we say to all our students, and some of your attendees will not probably want to hear this, but this is how you have to approach it. When you start, it is not about the money.
Yeah.
It's about consistency. If you can find a methodology that gives you consistency, and you can trade micro lots consistently on a weekly and monthly basis, you have cracked it. Because all you have to worry about is then moving up the lot size. So you then start with a micro lot, you then start with multiple micro lots, you then go to mini lots, and ultimately you end up in lots. But in addition to that, obviously you've got to build up your trading capital, but that's the way it has to be. You have to accept that when you start, don't start because you need to earn an income. You have to keep the day job. I'm sure a lot of people listening will have day jobs. Keep the day job. Learn on somebody else's time and money. You have to go to slower time frames. If you're out at work all day, that's fine. Absolutely no problem. Learn on somebody else's time. But when you start with the smallest contract size possible, 1 micro lot. That's what we always say. Start with 1 micro lot. Maybe after 3 months, step up to 2 micro lots. And then you start to learn about things like scaling in and scaling out and what suits you best and all the rest of it.
Also. And another question is, guys, sorry, we won't be able to. There are a lot of.
I can stay here all day, but I think Theo has got commitments.
Is it the same? I think this relates when you referred about the candles and the manipulation prior some market open, sort of joining the and stuff.
Yep.
Is it the same situation on New York market open?
Absolutely. You will see it everywhere. You will see it, as I say, I trade index futures a great deal.
Yeah.
Globex runs 24/7 pretty much. When the physical US market opens at 2:30 our time, the volume prior to that is very small, and you get this massive surge in volume and massive volatility and massive manipulation at that point. But you'll see it everywhere in the Forex market. Okay. You'll see it the crossovers in London, in the US, Europe, into Far East Asia, whatever.
And what time frame are you talking about for these candles? Is it any
time frame?
Any time frame?
I could have been, and this is the beauty of volume. It doesn't matter what the instrument is. It doesn't matter what the time frame is. Once you learn the principles are identical across any time frame. Whether you're on a 15-second chart or a daily chart, the principles are the same. So you don't have to relearn anything. You just have to learn the principles and then just apply it to whatever time frame you choose.
Yep. And the last one, really, because time is pressing us, I will just, guys, apologies, I will just pick randomly. I'll scroll a little bit and just pick randomly the last one. So what time do you trade the markets? I think that one, it reflects to many of the audience. So, David, what time do you trade?
What time? Well, Anna and I are very fortunate. We're in the Northern Hemisphere, so we have the best of everything. We have the London market open, we get the US open, we can trade, through the US day. So we can literally trade the deepest liquidity, because for us, we tend to take it as a given. But I know for a fact, if in the Far East markets, when you look at activity and volume in the Far East markets, it's pretty thin at times and it's tricky to trade. So we are very fortunate. If you're learning to trade, then the best time to learn and the best time to be able to trade, if you're fortunate enough to be in the Northern Hemisphere, is really the London, because that has the deepest liquidity. And into the US session, once you start to get to the end of the US session, obviously you start to move into the Far East and volume will drop away. So the deepest liquidity is London, bar none. So
I learned it the hard way, though, because I used to live in Australia back then, and trust me, I was trying to stay away for the New York session. It. But at least for the London session, sometimes I was managing it, and it was when I moved to Europe, that's it. That's the here.
And you've also got to remember, in each session, if you break the session up into into thirds, you've got the London, US, and Far East. You've also got to remember, as a Forex trader, that the focus of attention in those sessions is very, very different. If you go out to the Far East session, they're not interested in the pound.
Yes.
They're not interested in the euro. It's the dollar, the yen, and the commodity currencies. Equally, as you come into Europe, we're coming out of the Far East, we're coming into Europe, we're into the euro, pound, and the dollar, and then you move into the US session where, it's heavily dollar focused, Canadian dollar, etc. So you've got to remember that the focus of attention for your listeners is that whatever session they're trading, they've got to remember that the currency in focus is not necessarily the one they want to be trading. So you've got to match what the market is focused on and not what you may want to trade.
That's why you said at the beginning that it's a bit complicated, a bit complex. It's want to master the Forex market.
It's simple in the sense of getting in, and it's simple in the sense of the number of, let's say, valid currency pairs that we concentrate on, 27, 28 pairs that we concentrate on. So we haven't got to go, once you move into stock market investing, all the rest of it, you're dealing with tens of thousands of stocks. It's mind-boggling. Within the Forex world, you're only dealing with, the majors, 28 currency pairs, let's say. So in that sense, you don't have to move outside of that, but it is all the nuanced complexities of the Forex market that make it that much more difficult.
Yeah. Okay, awesome. I think, as David said, if we could stay here for hours and hours and hours.
I can stay here all day.
Certainly the time doesn't allow us to do that. So, and yes, at this point, ladies and gentlemen, unfortunately, we have to end this brilliant, informative session with David. David, thank you so much for joining us.
Thank you for inviting me, and thank you to all the people who've come along and taken an hour out of your day. I do appreciate it, and I hope you found something that you can hang on to. And all I would say is, if you've not discovered volume or you've not investigated volume, please do yourself a favor and just spend, a little while investigating it.
Okay. I'll promise that I will include it on my live trading sessions here at Admirals, and we're gonna see you. I'm sure that we're gonna see you soon in another webinar. Okay.
Fantastic.
Different style. It's gonna be more chart involved, but something we're gonna do about that, because I'm surprised by all these comments here. So many positive comments. Now we need the next invitation. Yeah. Okay. So, ladies and gentlemen, again, David, it was a privilege and honor to have you here.
It's been my pleasure.
Thank you guys for your participation. I'm sure you gained a lot of value out of this, and I wish you all the best. And
Thank you.
I will see you tomorrow at the live trading webinar here at Admirals. Thank
Fantastic.
you, everybody, and have a great.
Thank you so much. Thank you, everyone. Thank you.
Bye-bye.
Bye-bye.